Hi, I'm Peter Rose, founder of Longwood Currency Trading. The only economics you need to know in order to trade the Forex market. That's what the topic of the video is on this beautiful end of September 2023 morning. It is early morning. And what we're doing is we're waiting for the US Fed report on interest rates to come out, and that's the economics that you need to know. Interest rates are really the big dog in the economics of the Forex market. And the reason for that is because as you raise, as a country raises its interest rates, it makes its debt more appealing. I think the 10-year T-bill in the US right now is 4.37%, and it's the highest, this is 2023, and it's the highest that it's been since 2007. And so if people can get more money by buying T-bills than they can in buying British debt or Australian or whatever, they're going to sell their British pounds to buy US dollars. If they buy US dollars, they got to buy US dollars in order to buy T-bills. The buying pressure on the dollar creates the dollar to go up. So if you have a GBP USD pair, that pair is going to go down because the divisor is USD, and you're dividing a bigger number into a smaller number, the pound, and so that makes the pound weak in comparison to the dollar. If you had USD CHF, that would go up. Okay, so that's the key. That's the dog in the whole thing, is the interest rates. It becomes a little more, and I would just simply say that we've been in unprecedented interest rate times since the pandemic hit, when the Fed began its enormous printing of money and debasing the dollar as a result of that, just putting tons of money into the economy to try to save it. And that caused the inflation. And as inflation goes up, the only way to stop that is to charge people more money for borrowing the money. And that's what's causing economic conditions. It's the interest rates that do that. Now, during, let's put that in air quotes, normal economic times, you don't have the Fed changing the interest rates that much at their meetings, at their interest rate meetings, because the economy is doing fine. If they can get the U.S. economy at around 2% growth GDP on a yearly basis, then that's fine. You just have to be aware that it's really the interest rate policy that governs the whole rest of the economy of the country, or the countries in the two countries in the pair that you're dealing with. But what do you do in, again, normal times when the interest rates aren't changing? I mean, everybody's sitting on their computer keyboard ready to hit what's going to happen at 2 p.m. this afternoon Eastern time when the interest rate decision comes out. I'll be there to take advantage of some of the swings. I'm not going to try to play for a 20 pip run. I'm just going to go in heavy and take 3 or 4 or 8 pips, make $500, $600, $800, call it a day. I mean, I've already made $2,200. $2,200 I made already today. I made $1,800 yesterday, and a lot of that is because of the volatility in the underlying price of the currency pair that I trade. And that volatility is being caused by all this inflationary pressures, the jobless reports that are coming out, the personal income, and what the T-bills are priced at, and the interest rates. But it's all being driven. I mean, the economy is dictating what the interest rate is going to be. So if you're going to go into normal times when you don't have every month somebody's threatening to jump the interest rate or drop it or whatever you're going to do, because now what's going to happen is they're going to start dropping the interest rates after things get settled down, and so we're going to have a series of drops in the rates. So that maybe that's going to mean that the dollar will go down for a protracted period of time. But you don't know. And it's not in our ability as retail traders to figure that out. We're not PhDs in economics, and that we don't have Goldman Sachs with 100 PhDs in economics advising the traders and having detailed knowledge of every other major currency country in the world, what their currency policy is going to be, or their interest rate policy, and correlating all that data and running their simulation models. We can't do that. So to study fundamentals is crazy. You're just not going to be able to do anything. To study the economics of it is crazy. You just can't do it. I talk about it and I do it because I'm interested in it. But I'm not so interested in it that I want to be doing, economics theory. What's the dog in the thing? It's the interest rates. Okay, so if interest rates are going to start to slow, and then what are they going to do when they slow? They'll start to cut the interest rates to increase the demand again in the economy, because high interest rates causes recession because people can't afford stuff. People lose their jobs. They can't find another job. It becomes a very tough situation. So when everything normalizes, what happens then when the interest rates don't change? Well, then you have to look at things that do change that are reported. Personal income, that's trackable. And that report comes out and that jacks things up. The unemployment numbers that come out I think it's the first Thursday of the month or whatever. I don't know what it is. My calendar beeps at me and goes, hey, we got that happening today. I don't worry about this stuff ahead of time. If you're going to get a major announcement, it may start to affect things the day before in the currency markets. When you look at a non-farm payroll trading day, man, you get 5-minute pin bars that are 50 pips or 20 pips or something like that. I mean, your price just goes all over the place. And then a couple hours later, 50% of the people were wrong, so you have a 50% retracement. It has nothing to do with freaking Fibonacci number. It's the characteristic of the market because it's a zero-sum game. And things settle down and price continues on to where it was headed based on the institutional traders who have the ability to figure out where the price should head. So if you have a rising price in your currency pair that you're looking at, and you get NFP to come out, it goes all over the place and it goes way, way, way down, well, 50% of the people are wrong. So then it's going to come back up and settle. And regardless of what the result of that particular release number was, if the price was rising before and the number comes out and says, well, price should go down, it's going to continue to rise for a while because it's like a big ocean liner. Economies are like big ocean liners. They're not like 14-foot runabouts where you throw the tiller over and away you go in some other direction. It takes time to implement these changes. These major interest rate changes that we're seeing today in since 2020 up through 2023 through the pandemic, the interest rates have risen. I think they've raised them 15 times, quarter of a point, half a point, whatever, to get things under control. But they say it takes a year to a year and a quarter before you see any kind of effect. And that's the cruise ship effect or the oil tanker ship effect. It takes time for the boat to change. It takes time for all these changes to filter down through the economies so that you can see them in the charts. Oh, unemployment's going up, or gasoline's going down, or whatever it is that's going to happen because of the changes in the economy that are created due to the interest rate policies. When you get into sort of a semi-state condition, the economy may range between 1.5% a year to 3% a year, somewhere in that boundary range. You're not going to get interest rate changes 2 times during the year or something like that are of any effect. They're just minor tweaks. And so what you are looking at then, if you're interested in a longer term view of the currency market, is going to be, as I said, personal income, non-farm payrolls, unemployment, stuff like that. Well, how do you know which ones they are? I mean, you just go to any of the FOREX websites, and they will show you with the little American flag or the Mexican flag or wherever you are in the world, what economic releases are coming out for your country, and they just do a little research and see if that particular statistic is heavily weighted for your particular country. If it is, write it down and just track it, and you'll see that they all correlate pretty much together. And so that's where confluence of information might be helpful for you if you're interested in the economics, and if you're looking at building rules for your trading plan. You know, when you're looking at markets, you're looking at chop prices all over the place. You're looking at when it's range bound. You're looking at when you have a trending market, and you have periods when the price action is fading, what the economic gurus and stuff are saying. So there's something underlying going on there, which would indicate that one country's currency pricing or policies is so much stronger than the other countries, which is reporting prices that should send it up, but the other one is going down. It's very confusing. And so the more information that you have about economics and monetary theory, the more confused you're going to get. You just can't. And I've done videos on you just can't look at this stuff and make your trading decisions based on that. You can't make your trading decisions based on it. But what you can do is you can look at these numbers. You can say, hey, when I go to the store, are prices going up or are the prices going down? When I go to the gas pump, when I go out to dinner, is my dinner gone from a $20 entree meal to a $22 entree meal? Why is that happening? What are the was there a income tick up in income or tick up in the employment rate? What does the world look like that you're living in? If you just look around and you go, Jesus, things are costing a little bit more than they did last month. Well, you know, maybe that's going to have an effect later on, and so you're aware of that. You can't say, oh, gas just went up 40 cents, and I'm going to go out and whatever pair I'm working with, maybe the rise in the gas prices would affect one particular currency pair to go down, maybe it affect another one to go up. You have to pick your currency pairs so that the economic information is the big dog in the thing. You can't have these cross pairs or the exotic pairs where a bunch of retail traders can get together and swamp the thing like the Robinhood guys did to some stocks, because they all just get it in their heads that price is going to go up and everybody buys, and the whole theory there is some dumbass will buy it from me. And so the price continues to go up until everybody goes, well, we don't want to buy it anymore. We want to sell and get our profits, and then down it goes. Currencies don't quite work that way because the retail markets, us, are only about, I don't know, it used to be 15% or so. I don't think that it's even that large right now because we're dealing with a $6.7 trillion a day market. So what do you think? Do you think the retail traders are going to change that price? Well, if you go into quiet times and you get a bunch of retail traders out there that are speculating on stuff, or they need to get out of their positions, and both countries' prices are offline, and you get these guys to go in and trade in 300, 400, 800 lot positions, and you get a bunch of them all have the same idea at the same time. Well, just last night at 2 o'clock in the morning, there was a 40 pip 1 minute pin bar. 40 pip. It wasn't quite a pin bar, but the tail on the thing was really long, but the body was probably 4 times longer than the tail, but the tail was 15 pips, I think, on a 1 minute. And yesterday there was a 60 or 50 pip 5 minute pin bar. Maybe it was a 1 minute. I don't know. They're just big moves, and they happen in the middle of the night at 1:30 in the morning for a pound dollar or euro dollar or something like that. Everybody's asleep in the U.S. and they haven't opened the markets yet for the Swiss or anything, and yet those markets moved, and the spreads on them were immense. Well, that's the retail market causing that, not the institutional traders, because the institutional traders are home sleeping. The key to this video is that you have to be aware of interest rate policy, monetary policy, to some degree, and understand that the second tier level of stuff has to do with unemployment figures, income, non-farm payroll. There might be a couple others, but you don't want to get more than 3 of them. You know, if you have 3 objects, you can put them into 21 different permutations, and that creates a cluster of ordering that you may not want to get into or have the skill to do that. So what's the interest rate? What's the non-farm payroll is going to look like? What's the unemployment looking like? And you get a kind of just a bare feeling for what those numbers mean as they apply to the currency pair or pairs that you're trading, and figure it out. It's really, really complex. It takes PhDs in math and economics in order to make sense of all this stuff. You're not going to be able to make sense of all of it, but you need to be able to respond to it. The guy that goes out on the ocean to surf doesn't need to understand wave dynamics other than to look at it and go, that wave looks like it's building to be a bigger wave. And the reason behind that is there's a rise in the sandy bottom at that point, and it's causing the water to pile up and make the wave go higher. That's all you need to know. You don't have to know about Brownian motion theory and all that kind of crap, wave thermodynamics and all that shit. You just look at it, right? So you look at the economy that's around you, and you know that the economy is controlled primarily by the interest rate policy, and that the interest rate policy is created as a result of non-farm payrolls, unemployment, and that sort of thing. So just 2 or 3 things that you need to kind of keep in the back of your mind. And you read the business news a little bit, and geez, you know, the unemployment rate's going up a little bit. Well, why? Why is that happening? And don't study this stuff. Just say, well, this is going to affect the economy. Whose economy is it going to affect? What's happening in the other country's economy? Is their unemployment going up as well? So that means that the 2 countries are going to be fighting for dominance over which one's going to go up and which one's going to go down. So if the unemployment numbers are about the same, then what's next? If you want to do some research, that's the way you would go about doing that. But the number one thing that you should start with are the interest rates. Make it simple. Base your decisions on that. And your skill at trading, not abrogating to, oh, interest rates went up 1%, and so therefore I'm going to do X, Y, Z. That's not trading. That's a piece of information that you can use to determine a directional bias, perhaps, that you may have in your trading, but it's not trading. Because trading can be done in a vacuum to everything else if you're going to do it as a day trader or as a scalper, because you really don't care about any of that stuff. You just look, the price reflects all that stuff. All that information about non-farm payrolls, interest rates, theory, and all that, that's all reflected in each tick of that price. And if the tick is going up, it means that your price, if you're euro dollar, for example, and that price is going down, it means that something's going on in the U.S. that's stronger, or something's going wrong in the Eurozone that's making the price go down. It doesn't make any difference. It's reflected in the price. So you see the price going up, it doesn't matter. Price is going up. Trade it. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.